Yes, hello guys. Good morning, good afternoon, good evening, depending on where you are. My name is CPA Makan, and today I'll be taking you through financial reporting and analysis under CASNEP syllabus. That is topic 2 under accounting for specialized transactions. So welcome and enjoy the lesson. Thank you. Yes, that is topic 2 according to CASNEP syllabus, accounting for specialized transactions. Now, in this accounting sector, it is a very wide sector that we need to ensure that we get all the concepts relating to each and every subsector in this accounting concept. So this particular sector is dealing with specific specialized transactions that are bringing challenges when comes to accounting for them. For example, we are going to know at what point are we supposed to recognize revenue from number 1, higher purchase price, from number 2, on cost of construction cost, then number 3 on the borrowing costs. So these 3 are what we call specialized transactions because of the nature in which they seem to appear. They are a bit tricky to account for them, and therefore today, by the end of the lesson, you will be in a position to understand as an accountant, understand as a accounting officer in that particular entity in preparation of financial statements on how these particular transactions are supposed to be treated according to the international accounting standards together with the international financial reporting standards. Therefore, today I would like to cover specific areas. Under this one, we are supposed to cover number 1. Number 1 is IAS 18, specifically accounting for revenue. Accounting for revenue is under IAS 18. Then I will also be covering number 2 is the same IAS 11, specifically on construction contracts. Then the last one, according to the CASNEP syllabus on this particular specialized transaction, is the borrowing costs. So IAS 23, that is on borrowing costs. So these three specialized transactions are very important, and they pose a challenge to an accountant, especially on how to treat them when it comes to preparation of financial statements. And therefore, by the end of this lesson, you will be able to understand each and every one: IAS 18 revenue, and IAS 11 construction contracts, and IAS 23 borrowing costs. So welcome and enjoy the lesson now. So let's go to IAS 18, accounting for revenue. By the end of the lesson on accounting for revenue, by the end of this particular lesson, we are supposed to know number 1, meaning of a revenue. Meaning of revenue. Very important. By the end of this lesson, you should be able to explain the meaning of the word revenue. Number 2, by the end of the lesson, you should be in a position to recognize revenue. Recognize revenue. Number 3, you should be in a position to recognize, not recognize, but value, measurement. Measure of revenue. So by the end of the lesson, you should be in a position to do 3 things. 1, meaning of revenue. 2, recognition of revenue. And number 3, measurement of revenue. So these three concepts are very important when it comes to IAS 16, IAS 18, specifically on revenue. Now, first and foremost, let's see what is the meaning of the word revenue. Revenue. Now, what do you think is the meaning of the word revenue? First and foremost, for us to understand the meaning of the word revenue, you have to understand, first of all, the nature of transaction. If you are in a position, if you are dealing with the goods and you sell these goods to the third party, and then the third party promises to pay you money or pays you directly, we say there is a revenue. If you have offered your services like transport, or maybe your cyber services you have offered, or you have offered accounting services, or you have offered your taxation services, or you have offered your financial management services, you intend to get, or you are promised to get revenue, income, money by the end of the service, or you get it instantly. That is what we have what? Revenue. Number three is when you are using now, you are using assets for other companies. You are using other assets for other entities. For example, you have given your money to the bank. The bank is using your money to generate the income from their end, and they will pay you what you call interest. So this interest also, your money as an asset has been used by the bank, and you are getting an income. Number two, it can also be on the side of the SACCOs, or a SACCOs or any other pool of money, whereby you have contributed your shares, another person has also contributed shares. By the end of it all, that particular entity will trade with your money, and at the end of financial year, you will be given what they call dividends. So dividend is also part of the revenue. We have also a scenario whereby you have been given to use the rights of a particular musician, or the rights of a particular software. That is where you pay what you call royalties. So these royalties actually will be acting as what? Revenue. So in this case, those are examples of revenue. And therefore, what is revenue then? We can now say that revenue is gross. You can say revenue is gross inflow. The gross inflow of future economic benefits to the entity over a period of time. Over a period of time, specifically over a period of time, over a period of time. So in this case, there is the word gross, or benefit, future economic benefits. So in this case, we are expecting some inflows once we have offered our service, or we have given our goods. When you have given your goods to the third party, you expect an inflow, cash inflow. And for that case, it can automatically happen in the future. Immediately you finish the transaction, that is the time now you expect economic what? Benefits. These economic benefits should be for a particular period of time. Correct? So if they say a particular period of time, it means that you cannot consolidate. It will be per period. That is now specifically based on the IAS 1. That is preparation of financial statements. That is specifically preparation of statement of income and comprehensive incomes. So when you go there, IAS 1, under our YouTube videos also, you'll be able to know how to prepare that under that particular element. So therefore, revenue is a gross inflow of future economic benefits. Correct? Then we can now say examples of these examples of revenue. Examples of revenue are in three categories. Category number one is sale of goods. Immediately you sell on goods either in cash or in credit, we say that is what? Revenue. Number two is when you are issuing now services. That is rendering service. Rendering services. When you are rendering services, that is a time now you say you have the revenue. Then number three is use of others' assets. Use of others' assets to earn use of other assets to earn interest. Underline that word, interest, very important. Then use of other assets to earn royalties, very important. Royalties, very important. And then also to use other assets to generate dividends. Correct. Now, we are saying that examples of revenue will be sale of goods, rendering of services, and use of other assets. In this case, we are going to see one by one, each and every part. First and foremost, before I go into these three elements here, let me discuss first of all recognition of this particular revenue here. So therefore, in this case, for us to recognize recognition of revenue, for you to recognize revenue, you must meet two main conditions. Condition number one, you must meet this condition for you to recognize revenue in the books of accounts. One, if it is probable that future economic benefits will flow into the entity. Probable here, you discuss the meaning of the word probable in Financial Accounting 1, whereby you are saying probable means most likely, which means it is above 60% probability of getting revenue. Therefore, in this case, you can recognize revenue in your books of accounts if it is probable that the future economic benefits will flow into the entity. Number two, these future economic benefits here can be measured reliably. Very important. These future economic benefits can be measured reliably. Can be measured what? Reliably. These are two main conditions. We have also other conditions like number one, if there is fully transfer of risks and rewards to the third party, that is the buyer. That is another third condition. The fourth condition is that if you are able to measure the costs incurred in the transaction of this revenue here, can be measured reliably. So if you are able to measure the cost that you have incurred for this particular revenue to be realized, that is the time you say you have what? Recognized, you can recognize revenue. So there are four conditions, but these are the main ones, two. Now the four conditions will come in now when we shall be discussing in detail here. Now we go to sale of goods. Now when you are selling goods here, you can treat this one as revenue in your financial statements. For you to treat this sale of revenue in the financial statements, you must meet specific conditions. We call them conditions to recognize the sale of goods. Condition number one, these ones now. One, it is probable that economic benefits will flow to the entity. Very important that this particular sale here, it is probable, it is highly recognized that this particular revenue will flow into the entity. Number two, that the economic benefits yes, economic benefits are measured reliably. That these particular economic benefits you are being told here can be measured reliably. When you talk about measured reliably, you are just talking about the market price. That you are able to calculate it properly by saying, take the market price Correct? You multiply by the units of your goods. Then the third one, the third case now here is that when the goods, when the risks and rewards have been significantly transferred. Okay, so significantly transferred to the third party. That is, when you talk about the third party, you are just talking about the buyer. That in this case now here, the risks and rewards of ownership of the goods or the services you have been significantly transferred to the third party. So if you have transferred all the risks and rewards of ownership to the third party, then you can recognize this one. Number 4 is about the cost now. When the costs relate to transactions can be measured reliably. When you talk about costs here, remember we covered about the identification of costs here. We say costs made up of higher purchase price less any discounts. We also say transport costs. We also talked about the taxes. When you add all those together and get the figure, we call it what? Costs. If you are able to identify the purchase price from the assets, from the sales you have made, you are able to identify also the transport cost. You are also able to identify the tax. Then we say you have measured them goods reliably. Then the fourth one is purely about now the stage of completion. The stage of completion can be reliably measured. Reliably measured in the statement of financial position. That you are able to trace now the stage of completion of that particular service you have offered in the financial statement. Therefore, this stage of completion here will be covered under IAS 23. That not IAS 23, but IAS 11. That is construction of contracts. Construction contracts. We shall be discussing about this. So, for you to recognize sales of goods in the financial statement, you must meet all these conditions. Condition number 1, number 1, it is probable that the economic benefits will flow into the end team. Number 2, the economic benefits can be measured reliably. Number 3, the costs can be relating to this transaction can be measured reliably. And also, you are able to see significant transfer of risks and rewards to the third party. And finally, you are able to trace the stage of completion. In examination questions, when you go through the examination question from CASNET syllabus, you will be able to see this topic called IAS 18 properly captured. You will be asked to highlight the conditions necessary for recognition of this particular element. Now, that is under sale of goods. Then we go to the third one. The third one is about rendering of services. Rendering of services. So, rendering of services, those people who offer the services, they don't have goods, but they have skills. If you are a salonist, you fall under this particular category. If you have a garage, you fall under this particular category. If you have the hospital is made up of two things now. We have the goods in terms of medicine, and we have also the services. That is now the treatment of the diseases. It will fall under rendered services and also goods. If you are also teaching like me here, I'm giving out a service. If you are in the transport sector, that is also a service. For that matter, how do we recognize revenue there? The 5 conditions will still remain the same. That condition number 1, for this case, for us to recognize revenue on the rendering of services, 1, it is probable that future economic benefits will flow to the entity. Very important. They are the same, like the sale of goods. Number two is also about the measurement of this one, that the future economic benefits can be measured reliably. Very important. Then this revenue, this economic benefits here, that is in the form of cash that you receive in the future, or you have just received now. Those are what you call economic benefits. These benefits did not just occur in a vacuum, but there was a cost incurred. So this one, you are also supposed to recognize or measure the costs that you incurred for you to match with the revenue. So in this case, you can now say the costs relate to rendering services can be measured reliably. The cost that you have incurred to generate that future economic benefits can also be measured what? Reliably. Then, on the same note now, we can also say, yes, you have transferred all the risks and rewards of the services to the third party. So, but these are the main ones for this particular element. Correct? Now, we go to what we call interest, royalties, and dividends. When do we recognize them in our books of accounts? When I was going through the CASNEP syllabus, not syllabus but the questions, I found a question that was highlighting, saying, highlight methods, ways in which the following revenue can be recognized in the financial statements. A, interests. Recognition. Let me add the word recognition. A, interest. B, royalties. C, dividends. When do we recognize this? How do we recognize this one in the books of accounts? So for us to recognize the interest in the books of accounts, we use now effective interest method. We use effective interest method to recognize interest in the financial statements. When you talk about effective interest method, we are talking about the rate at which it is prevailing at that particular time. For example, if you go to the financial institution and apply for a loan, what happens? You are given a loan at a particular interest rate, but immediately you leave, maybe the interest rate in the field keep on changing. When it keeps on changing, what will happen? It can either go up or come down. So that fluctuation of interest is what we call effective interest rates. And therefore, interest is purely measured based on the effective interest rate. So it was 1 mark, according to the question. Then how do we measure also? How do we recognize also revenue, royalties? We recognize revenue royalties use accrual basis. When we talk about accrual basis here, we are just talking about recognizing revenue immediately as it occurs and recognizing expense immediately they incur, but not when you receive and pay. We go back to financial accounting 1. you'll be able to understand the meaning of the word accrual basis, whereby it was stating these are bases in which revenues are recognized when they are transacted, and expenses are recognized when they are incurred, but not when you receive and pay. Then dividends are also recognized. You are also recognized dividends in your books of financial accounting if you have established rights rights to receive the dividends. So you can only recognize dividends in the books of accounts if you have discovered that it is true and it has been approved at annual general meeting that the dividends are to be paid. But if there is no annual general meeting called for approval of the payment of dividends, you should not recognize the dividends in the financial statement. You can only recognize that if you have established that the rights to receive dividends have been approved, so by the shareholder. So the examiner wanted you to have these 3 marks like that. You can see how simple they are. Now we go to measurement of recognition. Measurement of, not recognition, but measurement of revenue. Now, measurement of, remember, we said from the word go, when you go back to financial accounting, when you talk about measurement here, we are just talking about the value. How do we value the revenue? At what time do we value revenue, and at what rate? So when you talk about measurement here, just talk about valuation of revenue. So revenue are actually valued at fair value. Fair value of consideration. Fair value of consideration received or receivable. Very important point. That we can only measure the revenue by use of fair value of consideration received or receivable. When you talk about received here, I'm talking about cash. That you have sold or goods or rendered your services on cash basis, or you have also sold goods on credit or issued or rendered services on credit. Correct? Now, on this case, it says that fair value means market price. We say that fair value, when we talk about a fair value, we are talking about the price. The price in which asset can, the price in which asset can be sold at, or liability can be settled. The price at which an asset can be sold at, or the price at which the liability can be settled at that particular time, is what they call fair value. Which means, I'm just talking about the fair value means the market price of the goods or products or services. So therefore we are able to value this particular element like that. Now, allow me now to go specifically on revenue specific areas. Remember, I said that revenue is covered under IAS 18. So I've discussed about what is the meaning of the word revenue, components of revenue, which I've said component of revenue are a sale of goods. That is number 1. I've also said rendering of services and use of other assets to generate interest, royalties, and dividends. Then I've also went ahead and discussed about the measurements of revenue, which I've just concluded here. Now, where do we go? Where are the practical areas of sale of revenue? The sale of goods. So let's go directly to a small part now, which will involve a lot of computation. So we have given out conditions necessary for you to recognize revenue in the books of financial accounts, financial statements. Therefore, we are going to discuss about specific area that is a specialized area under revenue called hire purchase price. Hire purchase. Another word for hire purchase is installment sale. Correct? Hire purchase or installment sale. So hire purchase sales or installment sales. Sometimes you might not have cash directly to buy the asset or to acquire the service. And because you don't have the cash directly, the owner of the assets or the owner of the services may render them in terms of hire purchase. You will be asked to say now, because you don't have this, pay some amount of money. That amount of money that is paid before you get the service or you get the goods is what they call what? Deposit. So under the hire purchase terms here, it means that the owner will be given the entire risks and rewards will be of ownership will be transferred to the buyer and by the end of the terms. Unfortunately, the buyer does not have enough money to buy the same asset. What will happen is that you will be asked to pay deposit, then the remaining you pay under what? Installments. So therefore, in this under hire purchase, the buyer will be asked to pay what they call deposit. Deposit here is the initial payment. Initial payment to have an asset. So that initial payment to have an asset is what they call deposit. Then the remaining balance is called what? Installments. So this is the remaining balance. Remaining payable balance. So the remaining payable balance will be called installment. And then we have now the period. This installment here will be paid over a certain period of time. This a certain period of time now will be attracting what we call installment what? Interest. Installment interest. Interest. So in the hire purchase, you are supposed to note that this is the installment sales. In this case, you have bought the asset, but you will not receive you don't receive risks and rewards immediately, but you receive it after you have completed your payments. The completion of payments now will be totaling to this. Therefore, we can now say, okay, then hire purchase price now will be made up of what you have paid initially to obtain to have the asset plus what you will pay after. So you are now determining the final price of the asset. In this case now, the final price will be now the deposit that you have paid initially before you get the asset plus the hire purchase price that you have paid. Not hire purchase, sorry. Total installment plus installments. Correct? Now, there was also what we call the cash price. The cash price is immediately the price that is marked there on the asset there or on the service. If you have that money, you can easily pay directly, which means it will be lower than the hire purchase price because there is no interest. But hire purchase is higher than the cash price because you have been given the period of time to settle. That period of time that you are settling will be attracting certain interest at a certain what? Percentage. Now here, cash price here, you just need to pay directly. So this is the cash price. Now the difference between the cash price and hire purchase price will tell you how much you have paid more above the cash price. That amount that is more above the cash price is what they call what? Installment interest. So therefore we can now say installment interest or just interest. Interest is given by hire purchase price minus the cash price. So if you minus the two, you will get that element. The question now here is, how do we account a hire purchase price? How do we account the hire purchase sale in our financial statements? For us to account the hire purchase sale in our financial statements, you have to account for the books. You have to ensure that you have the books for the buyer and the books for the seller. That is the only way you can recognize them in the financial statements. So therefore, we can now say recognition of this. Recognition of hire purchase price. For us to recognize the hire purchase price, we have to ensure that we have the books for the buyer and books for the seller. So we can now say books for the buyer, and then we can also have books for the seller. The seller. Okay? Now, if you are the buyer, it means you are the receiver of the asset. And if you are the seller, it means you are the receiver of cash. Correct? You are losing the ownership of the asset, and here is you are gaining the ownership of the asset. So risks and rewards are being transferred from the seller to the buyer. Now, the books to be maintained by the buyer are around 5 of them. The first one is the asset account. All assets are debited. So therefore, the asset you are getting from the seller, you have to open the account for that asset. Immediately open the account for the asset as the seller, as the buyer. Now remember, you have bought it on hire purchase, which means you have not completed the payment. So therefore, you will treat this seller as what? A vendor or a supplier or a creditor or a creditor. Now we open what you call the hire purchase vendor. That is a supplier. We can also call hire purchase liability, whichever the term you want to use. You can also call, there are 3 terms. You can also call a vendor, liability, or a seller. Why? Immediately you debit the asset, you have to credit the vendor's account as a liability. The third book that needs to be maintained under this is that this asset, because you have received on hire purchase and you have already the liability, it means that you have been given a period of time to settle. They will be creating what they call interest. Interest on the side of the buyer is an expense. So you now say interest expense account. Therefore, it means this interest expense account is increasing what? Is it an asset or a liability? Creditor. It is increasing the creditor or vendor's account. Therefore, you are debiting the interest expense account with this, and then you are crediting what? Hire purchase debtor account. Then, once you have this, you need also to open another one called depreciation account. Because this asset is undergoing depreciation, we have what they call depreciation account. So this particular asset you have is decreasing per period based on the depreciation account. Now, once you have known these books here, we can also list the books for the seller. The seller is the buyer the seller is now the owner of the goods or the services. Now the goods have been transferred to the buyer. Which are the books to be maintained there? So the seller will call the buyer debtor. So therefore we open what we call hire purchase debtor. Or we use debtors, or we use what the word? Receivables. So this person here is owed some money by the buyer. Therefore, because money is being owed to the seller has to open the hire purchase debtors account to account for the debtors. Then immediately under that, we have what we call so it is the opposite of this. Now we are crediting this. In this case now, we open what we call interest income. Interest income, or you can say receivables. You can see this one is calling the interest expense, but this person here is calling it what? An income. Then after that, immediately we have what they call hire purchase sale. Because you are debiting here, you are crediting the hire purchase sales. Correct? You debit, you see you are selling, so you open the hire purchase sales, then you open the debtors account. Immediately after that, you need also to open what we call a repossession. Repossession account is another book that is open mainly if the buyer defaults to pay the installments. If the buyer defaults to pay the installment, then the seller has a right to repossess or to own the asset back from the seller. So therefore, if that is the case, we need also to open what we call repossession account. And finally, this hire purchase sale need to be closed. You need to close the balancing figure in the hire purchase sales to the hire purchase trading. Hire purchase trading account. When you talk about trading account here, you are just referring to income statement. Then immediately after this one, because you have recognized this, you have also to close this one to the P and L account. So you need to open the P and L account. Then finally, because if there is any repossession of the asset here, it means there will be what you call unrealized profit. Unrealized what? Profit. This is the profit that is notional. We call it notional profit also. Notional profit. If you are repossessing, you can either have a notional profit or a real profit. So these are the books that need to be kept by each and every party. We have the two parties to account. Now on this note now here, we can now say entries. Entries, so we have now entries to account for this one. Then we have also entries here. How do we enter the book? How do we enter the transactions now? Number one, for this side here, if you are receiving the asset, we now say on purchase of sale, purchase of the asset. So we have the purchase of asset. How do you enter this in the books of account double entry system? You have to debit your asset account, this guy here. Then you're supposed to credit what? Crediting the vendor's account, hire purchase vendors with that figure. You can see a double entry here. Then that is number one. Number two, you are supposed to record deposit. How do you record deposit? Who has paid the deposit here? It is the buyer. So therefore it means you have credited your bank and you are reducing from your vendor. So you debit your hire purchase vendor with that deposit. Then you credit your bank or cash with the same amount. Then we also say to record depreciation. How do we installments? Sorry, let me just follow one by one. To record installments. Number three, installments paid. Now you have paid the installments. You are paying, you are reducing your liability account here. So therefore you are paying using bank. So therefore you just say debit your hire purchase deposit, hire purchase vendor with the installment amount. Then you are crediting your bank because you are paying from the bank. You can see that is how to make a journal entries. Then we have also what we call interest expense. Interest. How do we enter interest? So an interest here is increasing what? The hire purchase vendor. So you are crediting. So in this case, you have to debit your interest account, interest expense account. Then you credit your hire purchase vendor. Then we have what we call depreciation. How do we account double entry for depreciation? So depreciation is automatically reducing your assets. So therefore, you say you debit your depreciation account, then depreciation account, then you credit your asset. Correct? This asset is reducing. Then the last one is to close. You close this now here. This interest together with the depreciation. You have just recognized them. Now, close this one to the P&L account. When you are closing interest and depreciation to the P&L account, it means interest is turning to be an expense to the P&L. And the expense to the P&L is debited. Then depreciation is also turned to be an expense to the P&L. So therefore you are debiting P&L account and you are crediting your depreciation. Here you are debiting your P&L account and you are crediting your interest expense. Now let's go to this side also. Entries for this is this is very simple. How do you record the deposit that I've received? You see there is a deposit paid here. So in this case, to record the deposit is so simple. For deposit, you debit your debit bank. Correct? Then you're supposed to credit what? Debtors. I purchase debtors. Now record also the installments. So installments are reducing the data. So therefore you debit also bank. Debit bank. Then you credit your debtors. That is I purchase debtors. Now to recognize installment income, interest income. Now here you are increasing the interest, you are increasing the debtors, which means you are debiting debtors, correct? Then you credit your interest income or receivables. Then you are now recording the high purchase sales here. High purchase sales. This one, what is happening here? You are debiting your debtors. You are debiting your debtors with that figure. Then you are crediting your high purchase sales. Then you have done a repossession. So you have repossessed the asset. So the asset is coming back to you. So therefore it means on the repossession area, on the repossession, you have to debit your repossession account. Then you credit. What are you crediting? You credit what? Who had it? Debtors account. Now under this one, if you are repossessing this one, you might come and do what we call you might incur another expense. If you incur an expense here on the repossession of that particular asset, repossession account will increase, which means you debit repossession account, you debit what? If there is any expense. If there is any expense on repossession, on repossession, you have to increase the repossession account. So you debit repossession account with that figure, then you credit your bank because you are paying. Now, this figure, by the end of the day, if you have repossessed this account and you make a sale again, resell, which means you have found another person who is buying that particular asset, maybe in cash. For that case now, it is in the form of cash. Therefore, this resale here will be used purposely to determine the profit or loss. So this resale will be used to determine either profit or loss. So therefore, it means that in this case, we are putting them on the repossession account. So therefore, we credit repossession account, then we debit our bank. So in this case, you say debit bank with the cash we have received, then you credit your repossession account. Now, in the repossession account here, you will be now having either a profit or a loss. If it is a profit, transfer now to the P and L on the credit side. If it is a loss, transfer to the debit side of the P and L account, and you'll be able to answer these questions without any problem. Correct. So we have done the entries. We have now known the entries, buyer and seller books. Then we have also known the entries, debit and credit, which and debit what, credit what, debit what on this area. So let's go and see the expenses, the interest, which is now posing a challenge. What is posing a challenge in accounting for this particular hire purchase is the interest. So now interest is having a challenge here. Now for us to, in this case, we can now say yes, recognition. Not recognition, but let me start with the apportionment. Apportionment of interest. Now, apportionment of interest on hire purchase price is posing a challenge. Now, in this case, we have to apportion. How do we apportion the interest? When you are apportioning, it means that you are allocating interest to each and every installment. You cannot take, if it is for 3 installments, you have to apportion the interest for 3 installments. So how do we apportion this is a challenge. In this case, according to IAS, according to IAS 18, it is giving us 3 methods. Method 1, To apportion this, you can use straight line method. Straight line method. So you can use the straight line method to apportion what? Installment. So straight line method here means you are actually apportioning this interest equally to each installment. Correct? So each installment is allocated equal amount of the interest. We call it in straight line method. Therefore, you take the total interest, divide by the number of installments, so that you get each installment per period is how much. Number 2, apart from this one, we have what we call sum of digit method. Sum of digits method. This method states that the interest here need to be apportioned to each installment based on number of digits. Based on digits. Okay? So you apportion the interest to the installments based on digits. For example, if the installment is to be paid for 3 periods there, if the installments are 3 periods, you just need to say 3 plus 2 plus 1 is equals to 6. So there are 6 digits here. So for us to find now, first installment, second installment, and third installment, your work will be very simple. You take 3 over the total times the installment. So therefore you take 3 over 6 times installment. The second one is 2 over 6 times the installment. Then the third one, the last one is 3 over 6 times the installment. And you are able to apportion per period. That is what we call sum of the digits method. I normally caution my students not to say 1 plus 2 plus 3 is equals to 6. The reason is, if you put it like this, there is high probability that you will say 1 is 1 over 6 times the installment, then 2 over 6 times the installment, then 3 over 6 times the installment, which is very wrong. So the installment should be decreasing per period. But when you use this method, it means interest is what? Increasing per period. But interest are supposed to decrease per installment. So to decrease per installment, you have to begin with 3 plus 2 plus 1. Therefore, I normally tell my students, don't use 1 plus 2 plus 3, but use 3 plus 2 plus 1. If they are saying 5 periods, you say just 5 plus 4 plus 3 plus 2 plus 1. And this gives you around 15 in number. Correct? So that is how you are supposed to use that. The third one is what we call actuarial method. Actuarial method. Another word for actuarial method is reducing balance. This reducing balance I covered also when I was discussing about IAS 17. That is leases. I discussed about IAS 17 on leases. So this method was also there. This method says that you have to reduce the interest to be reducing per period. From the how much you have paid this period should be less than the amount of interest you will pay the following period, and it will also be lesser than the one you will be paying the third period, and so forth and so forth. This is how reducing balance is. Now, what about recognition? Recognition of interests. Recognition of interests. Now, for us to recognize interest in our financial statements, we have also been given 2 methods. Method 1 is installment method. Now, to recognize this, using installment method, we have been told first and foremost, this installment method, right? In method, interest, this particular interest now here is written off to the P&L account. Therefore, it means that your installment, this interest here, you are writing it off to the P&L account, which means you are treating how much interest per that period is written off in the financial statement. That is income statement and comprehensive. So you write it off in the P&L account. Then the third one, the second one is, not the third one, but the second one is suspense method. Suspense method. In the suspense method says that you cannot just write income statement interest directly to the P&L, but you have to write this interest, first of all, interest method. Write this interest first in the suspense account. And remember, we said a suspense account, according to Financial Accounting 1, a suspense account is an account that is mainly open to record those transactions that you need queries. That you have queries, you have not understood the transaction well, or you are waiting for the clarification on some transactions, on the receipts, or any other transaction for that particular organization. Because you are still waiting clarity, or you are still waiting for conclusive answer from the management about a particular transaction, therefore the account, the amount of money or whatever you are doubting should be recorded in the suspense account. So in this case, it states that this recognize interest first of all in the suspense account, thereafter recognize them thereafter, that is subsequently recorded now in the income, in the interest account, subsequently recorded now in the interest account, then finally close to P and L. So this one you are closing directly to P and L, but this one suspense account, no. You open first of all the suspense account. Then the balancing figure in the suspense account you transfer to the interest expense account. Then you close this balance in the interest account to the P and L account by the end of the financial period. Now, another area that we need also to understand on this one is method used by the seller to recognize gross profits. So methods to recognize what? Gross profit. Yes. Who is now registering gross profit here? Is it the buyer or the seller? It is the seller. How should the seller recognize the gross profit? So there are two methods. Method 1 is the cost method. Cost recovery method. Cost recovery method. Cost recovery method here states that the seller is recovering all the costs first. Once all the costs have been recovered, then the remaining will be treated as what? Gross profit. Correct? Recover first of all the cost you incurred to buy the asset. Once you have recovered the cost, then the remaining amount you will be receiving from the buyer will be taken as what? Gross profit. That is what it means here. Number 2 is what they call installment method. Installment method. In this method, it says that this gross profit need to be apportioned based on the installments. If you have the 3 installments here, you have to apportion the interest. You have to apportion the gross profit based on the based on this particular installment. For example, which we are going. Let me not give an example, but we are going to see how to apportion this method like this. So you are apportioning the gross profit based on the installment. Now, do we get the gross profit? Gross profit is calculated by revenue minus cost of sales. So we are going to see the two in the next few minutes. Now, when you have now this gross profit, there is high possibility that you register what they call unrealized profit. Unrealized profit is what they call notional profit. It's not a real profit because you have recognized, but sometimes you might end up repossessing the asset. Repossession of that asset means that you are tampering with the previous recognized sale, which had a profit or which had a margin. Now, because you are repossessing, your margin is being actually triggered for that matter and will be resulting to what we call unrealized profit. And therefore, for us to calculate unrealized profit, we have to take the hire purchase debtors, which is the debtors we have now at the moment. You divide by the hire purchase sales, and then you multiply by the gross profit. And the gross profit here is revenue minus cost of sales. So therefore, for us to get unrealized profit, you need to take hire purchase debtors. This is now what is remaining, the debt that is outstanding, divide by the sale of that particular asset, then you multiply by the gross profit. You will be in a position to answer the question correctly. Now, for that matter, I can conclude by saying the correct method to recognize gross profit is installment method. Why? This method is allowing the seller to allocate profits to each and every installment. Not like this one, whereby there is no recognition of profit in the first year, second year, until you recover your cost. So therefore, this is not realistic. The one that is realistic is installment method. So therefore, class, let's now go to our computation to prove our understanding. Let us go to our computation to prove our understanding. On hire purchase terms. So let's go to the questions. So therefore, class, I will be sharing them. You have the notes already with you, but later when we shall be posting this video to the YouTube, the notes and the questions will also be accompanying the video. So therefore, subscribe, like, and share with your friends to enjoy the CASNEP lessons. Correct. So let's go to the first example there. The first example for on hire purchase, I have 3 questions to discuss about the same. Question 1. On 1st January 2010, during a very dry season, Mr. Sonko Limited, an equipment without fear or favor. Sorry, let me repeat the question. On 1st January 2010, during a very dry season, Mr. Sonko bought an equipment without fear of or favor from Masikini Limited on hire purchase systems. The cash price of the equipment was 680,000. The hire purchase terms provided for a deposit of 200,000 and the balance in 3 equal installments of 240,000 payable on 31st of December each year. Using the sum of digit method to apportion interest, you can see they are giving you the method in which you will use to apportion the interest. They call what? Sum of digit method to apportion the interest, and suspense method to recognize. You can see I've already discussed that there are 2 methods to recognize interest. One is suspense method and another one is suspense. I've also discussed about installment method. So they are very specific. Prepare the necessary accounts in the books of the buyer and seller. Now, there are 2 methods of accounting for recognizing apportioning interest. One, we have said the first one is apportionment method by use of 1, sum of the digits method, straight line methods, and the actuarial method. Now, for the sake of learning, I don't want to use only what we have been told, that use the sum of the digits method. I want to bring in also the 2, that is the straight line method and also actuarial method for us for the sake of learning. But the question is saying use the sum of the digits method to apportion the interest, and specifically use the suspense method, meaning that the interest, for you to recognize interest, do not write interest directly to the P&L, but say charge the interest to the debtors. Then from there, open the suspense account. After opening the suspense account, open the interest account. Then finally, close the interest account to the P&L account. That's what they are saying. But we have what we call installment method. Installment method here means you just need to close the figure directly to the P&L account, which means open the interest expense, then close by the end of the period to that. So for the sake of learning, let's begin the question. Class, for you to get this question right, mark the specific areas. 1, on 1st January 2010, you mark that, which means at the beginning of the period. So we have 12 periods now to go. Mr. Sonko bought an equipment without fear or favor from Masikini Limited on hire purchase terms. Correct? The cash price of the equipment was 680,000. Correct. You start from there. Cash price is 680,000. This is the cash price. Correct? On the hire purchase terms provided for a deposit of 200,000. Deposit 200,000. Another information. and the balance in 3 installments, 3 equal installments. So we have installments. How many installments? 3 installments, each 240,000. 240,000. If you multiply, what do you get there? 720,000, which means the total installment by the end of the 3rd year, it will be 720,000. Then, and they are payable on 31st of December each year. So which means it was bought on 1st of January 2010. So we have now 2010, 2011, 2012, and 2013 to cover for 3 periods. Then you have been told using the sum of digit method to apportion interest and the suspense method to recognize interest. Those are 2 major points. But for the sake of learning, I want now to apportion the interest first using the 3 methods. That is a straight line method, sum of digit method, and actuarial method. So let's begin. Sorry. So now I have this information here. Now I can now calculate hire purchase. Hire purchase price is given by deposit plus installments. Which deposit is now here, how much is 200,000 plus installments of 720,000. So the hire purchase is 920,000. So you can see it has moved from 680 to 920,000. Therefore, it means that what has increased is what is interest. So therefore, I can now say interest here. Interest here is 920,000. Or it made me write a formula first. Hire purchase price minus cash price, which is now 920,000. You minus 680,000. Your answer is 240. If I'm not wrong, if you use your calculator very well, you'll find 240. So this 240 is for how many periods? 3 periods here. And we cannot, this is for 3 periods. If you are using straight line method, per period will be 340 divided by 3. But the question is saying, use the sum of the digits method. But now I want to use the 2 to apportion this. So I can now say interest apportionment. Interest apportionment. Interest apportionment. So let me use the method I've been told first by calling it A, sum of digits method. How many periods? 3. So you now say 3 plus 2 plus 1, you get 6. So installments here, we have the first installment, which is now 3 divided by the total, 3 divided by 6 times 240. Then the second installment will be 2 over 6 times 240,000. Then the third installment will be 1 over 6 times 240,000. So if you work out this, it has to give you 120,000. This one will give you 80,000, and this will give you 40,000. So that when you add this, it has to give you 240,000. That is using sum of the digit, which means that first installment, you recognize 120 interest. Second installment, recognize 80,000 interest. Then the third installment, recognize 40,000 as interest. Then B, straight line method. So straight line method, I just need to take 240,000, you divide by 3. So it will give you what? 80,000 per installment. So each installment will be 80 for 3. Then if you go to C now is what we call actuarial method. Now pay attention to actuarial method. We are saying it's also called what? Reducing balance method. Reducing balance method. This method looks to be difficult for some students, but it's a very simple one. Reducing balance, the remaining balance. Now the cash price is 680,000 and you have paid a deposit of 200,000. So if you subtract these two, you get what you call reducing balance. What is remaining now? So you can now say yes, you take now the balance, in this case, will be 680,000. You subtract 200,000. Your answer there is 480,000. So this 480,000 will be paid for 3 installments. Correct? 3 what? Installments. Now, for this actuarial method, you need to know also the interest rate. The interest rate given from the question is the interest rate is 10%. So which means that this amount here that you have not paid will be growing every year at the rate of 10% every year for 3 years. This one here. So therefore, I can now say, okay, from 1st of January 2010, correct, balance brought down is how much? 480,000. Then the interest will be by the end of the year, and you have been told it is payable on 31st of December 20 each year. So therefore, it means I have to pay the interest at the rate of 10% for 280,000. Then I pay the installments. In this case, you have been told what is the installment from the question. Installment is how much? Loan is 200, deposit. You have been told installment is how much? 240, yeah? Each installment is 240. So therefore, installment here is a reduction. So 10% of this, you get 48,000. Then you pay the installment. First installment is 240. If you are paying, then you are reducing. So the figures you'll get is the balances as at 31st of December 20x or 2010. So how much is the balance there? So if you work it well, your answer you get is 288. Here, 288,000. Now it will be opening figure 1st of January 2011. The balancing figure is 288,000. Then it will attract an interest 10% of 288,000 will give you 28,800. Then there is installment of how much? 240,000 installment. How much is the figure as at the 31st of December 2011? So if you work out that very well, you will be able to get 76,800. This is the second year, or the second period. Then we move on. Then this is the opening. This is now the balancing on 1st of January 2012. Balancing figure is 76,800. Correct? Then installment interest. Interest now here will be 10% of 76,800, which will give you 7,680. Then installments will be 240,000. Therefore, it means you would have overpaid. Okay? So instead of overpayment, there will be overpayment of how much? So if you take 76,800 plus 7,680 minus 240, you will get overpayment of that installment. So that is how you are supposed to use the three methods to account for installment. Now for this particular question, we are going to use the sum of the digits what? Method. The sum of the digits method. So allow me to wrap the board. I hope you have copied all. So let me wrap the board, then we move now on with the question. So if for the sake of learning, but if it was an exam, we could have just done this reducing balance method. If it was exam, we use only one method that you have been told to use. So I know some people here are praying, saying, no, let now straight line method come. I don't want this of reducing balance. But reducing balance, you can't run away from it because of what you call IAS, IAS 17, because it is also there. So let's see now. The question was saying, using the sum of the digit method, very carefully, we have found an interest to be 120 for the first installment, 80,000 for the second installment, and 40,000 for the third installment. Then method to apportion the interest, and suspense method to recognize interest. Prepare the necessary accounts in the books of the buyer and seller. Very important. Very important. So therefore, we can say now books of buyer. Let me begin with the buyer. Books of buyer. I don't know whether it can be enough. Let me try to see whether I can get the two. We have books for books of seller, books for seller, books of sellers, then books of seller. So there are different books. So we have to prepare these books. For the buyer, we need to have the account, asset account, right? So that asset account, what is the name of the asset from the question? It is called what? Equipment account. So we need to open the equipment account. Like that. From this equipment account here, there was no depreciation. So therefore, we can just say for 2010, by the end of 2010, balance was how much? For the asset was how much? The asset at that time was how much? 680,000. This figure, it is the balance carried forward remains 680,000. You close that figure. There is nothing affecting it. Then you go to 2011. 2011, this carried forward here is the balance brought down here. So balance carried forward still 680,000. You close the figure. Then 2012, 680,000, which is the balance brought down here, is the balance carried forward 680,000 here. That is the first one. Then the second one now is to open the vendor's account. Vendors, you see, this is the buyer asset, then there is a vendor, supplier or a creditor. So we can now say hire purchase, let me just write here, hire purchase vendor account. Whatever that is on the debit side here will be on the credit side of the vendor. So we can now say, okay, we have now 2010, correct? 2010, we have an equipment. They sold an equipment there. Equipment of how much? 680,000. But by the end of 2010, this equipment would have increased because we have already calculated and we found that there was an increment from 920,000 here. So it increased from 960 to 920. So the balancing figure is what you call what? Interest. Interest or installment? Interest. 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 How much is the interest there? How much is the interest? And this interest, you have been told, should be interest what? Suspense. Very important. So the balancing figure here, we have found to be how much? 240. You get that? Now, that is what is happening here. In which year? 2010. During the 2010 here, there was a payment made. So there was a deposit, which has to reduce this figure, 200,000. And there is installment. Using which method? Sum of the digits method. We found the first installment is 120,000. Then how much is the balance carried forward that is remaining by the end of the year 2010? So if you work out that carefully, you'll find the balance there being 480,000. When you go now to 2010, 2011, balance brought down is 480,000. Out of 480,000 here, suspense account, we have already captured that, correct? Then we pay. This year we are paying installments. Second installment is how much? Was it 80,000? Plus second installment? Not installment, but I've made a mistake here. The installment here is not 120, but 240. So that now, when you take 200 deposit plus this one plus that, you get the balance, this one. Yes, correct. Installment remains 240. Installment 240,000 for this year. So 200 and vendor. The installment you will pay by the end of 20x11 is 240, and it has to balance with this, correct? So the question is, how much is the balancing figure? So balancing figure to be carried forward, 240,000. So that now it gives you what? 480,000. Here is also 480,000. You can see. Then we go to 20. This is 2010, 2011. 2012. Balance brought down for 2012 is 240. Then that year you are paying the final installment. How much is the final installment? 240,000. So therefore there is no balance carried forward here. You just close like that. So that is how you prepare your vendor's account. We go to the third one called interest expense. Remember, you have to use the suspense method. So therefore don't take it just to interest direct, but open the suspense interest account. As you open the suspense interest account, what should come in your mind is interest expense account, interest expense account, interest expense account, because you have been told follow that rule. Now let's see. Now when you look at this question carefully, we have interest suspense from the vendor's account. So you can now say 2010, we have the vendors. I purchase vendor's account, how much? 240,000. Correct? Out of this 240,000, we have apportioned the interests. We have the first interest. We have the interest there. Using the sum of the digit method, we found the first one being 120,000. Then therefore from there, what is the balancing figure there? So that it totals to this. The balancing figure is 120,000. So you get now 240,000. This is also 240,000. Then we go to which year? 2011. 2011, for this matter, the balance here is 120,000. How much is the interest that we have calculated? Interest we have calculated. First year is this, second year was 80,000, right? You remember? So for it to be balance carried forward, you have to get 40,000 here. So if you add, you get 120,000. Here is also 120,000. Then you go to 2012. My board is small a bit, so my board is not enough, but let me fix it. This is the balance, 40,000 for the closure of 2012. Then you made an interest also in the year 40,000. So it is balancing. Immediately after this, you go there now. You can see it is on interest is on the debit side. So you now say from the suspense account 100, that is 2010. Suspense is 120,000. It's on the credit side. on the debit side. So this is balance carried forward, 120,000, which you have to close it to the P and L, correct? So this figure, instead of saying now 200 P and carried forward, you just say take it to P and L. How much? 120,000. In the year 2011, how much is there? You come just check. 2011 we have 80,000. You put your 80,000 here. Then you take the same to P and L, 80,000. Then you close. Then for 2011, 2012, 40,000. Transfer to the P and L, 40,000. Then you close. So you are through with the books of. You are through now with the books of buyer. We go to the books of the seller. So books of the seller. We have the books of the seller. Books of the seller. First of all, we said if you are selling, then what comes in your mind is hire purchase, debtors account. Debtors are always debited. So therefore, it is from here. Correct? So for that matter, we now bring it from here. You can see we have debited, you have credited here, not here but here, vendors. You have credited here, then you debit here. So therefore, we say from the vendors account, hire purchase vendors. That is 2010. You have 680,000. This 680,000 is attracting an interest. Okay? Of how much? Interest. This interest is in the suspense. How much was it? 220,000. So that gives you what? 920. But now out of this one you have received a deposit of how much? 200,000. Then you have also installments of how much? Each installment 220,000. Then the balance carried forward is the balancing figure, so that now you get your figure here as 920,000. So how much is the balancing figure? If you work it very well, you will get 480,000. So that gives you 920,000. So that is how to get that figure. Then you go to 2011. So balance brought down is this figure now, 480,000. Correct? Once you get the 480,000, there is what we call installments. How much is the installment? 240,000. So there was no deposit in the second year. You captured the deposit in the first year. So therefore the balance carried forward for that matter is 240,000. When you add, you get 480,000. 480,000. Then you go to the final year, which is 2012. Balance carried forward is 240,000, but there was an installment that was paid immediately. That is 240,000. So there was no balance carried forward. So you close now the first book of. So immediately you open this one, we have what you call interest suspense account. Now interest, here we now say interest suspense account. So interest suspense account. So interest suspense account, you can see already it is on which side? It's on this side, so it will be on this side. So you now say on the 2010 suspense account, from this particular, it was 240, correct? 240,000. Now from this 240,000, there was an interest. For which year? There was an interest of, first using the sum of the digit method, we found the first year to be 120,000. So the balance carried forward is 120,000. So this will give you 240,000. Then you close with this one, 240,000. Then you go to 2011. Balance is 120,000 here. Once you get the 120,000 now, you pay. Is there anything you are paying? Is there installment? Yes, there was an interest. Interest of how much? 80,000. So balance carried forward 40,000. So this will give you 120,000. This also 120,000. Then you go to the final year, that is 2012. Balance 40. How much was the interest? How much was the interest plus? How much was the interest? 40 also. So you close the figure, close the figure. So you are through with the suspense, interest suspense account. Transfer now interest suspense account to the actual interest account. So that is interest account is now called interest income account. You go to now interest income account or interest what? Receivable. Now, where there is an interest, you can see it is on the debit side, so you put on the credit side there. So you say now 2010, how much was there? 120,000. Now close this figure to the P and L. So you now say P and L to 120,000. You close the year. Then 2011, how much is the interest? 80,000. Put your 80,000 there. Then P and L, 80,000. Then you go to 2012, 40,000. Then here is P and L, 40,000. So there was no any other year. So according to this question, this is how you are supposed to analyze. Now you have made the sale of 680, right? So you have debited this 80. Where have you credited? I have not credited anywhere. Therefore, it means that there is an account called what? Hire purchase sales. Correct? So a debit is here. So I can now say, yes, there was a credit for that 20x11. So 2010, there was a sale of how much? 680,000. We sold at 680,000. Then we close the figure. Then we close the figure to P and L. Close the figure to hire purchase trading. You remember the hire purchase trading? 680,000. You close the figure. Then when you go to hire purchase trading now, we can use the vertical format by saying sales, how much? 680,000, correct? Then we have the interest, so that you get now 920,000. It was 240,000. Then this is now your adjusted sales. So then you can proceed on from there if there is any additional information regarding to that. So this one marks the end of our first example. So the second example will be actually dealing with the same. So I have two more questions on the hire purchase so that we are able to exhaust this question without any problem. So thank you so much and welcome to our next class on the second and third example on hire purchase terms. Welcome.